My name is Jake, welcome to the channel. In today's video, we're going to talk about why dividend investors love Reality Income. This is a company that I hold in my portfolio, and if you're a new dividend investor or a long-time dividend investor, you probably have heard of this company before. This is a real estate investment trust, and I would go so far as to say that everyone watching this video, at least if you're here in the United States, you have probably stepped foot in a building that is owned by Realty Income. If you've ever been to a Walgreens, a CVS, an LA Fitness, a Walmart, a lot of these buildings that you see day to day are owned by Realty Income. So that's what we're going to talk about in today's video. So my hope for this video is that after you've watched it, you truly understand why dividend investors love this company so much. And at the end of the video, I'm going to share my personal opinion of why I love investing into companies like Realty Income. And I'm going to give you a very detailed example of why that is. So if you're interested in my perspective, it'll be towards the end of the video. The majority of the video here is going to be objective. It's going to be based off of, factual information, but towards the end, I'm going to share with you why I invest into this company. So I hold Realty Income in my real estate portfolio. I have 3 portfolios in M1 Finance. I have the cash flow portfolio, real estate, and I have the little portfolio here for my little baby boy, Lucas. Realty Income is a real estate investment trust, and it is in this portfolio that I hold all of my REITs. I have other companies in here like WPC, Omega Healthcare, Stag, and so forth. But today's video, we're going to talk just about Realty Income. If you're not really familiar with what a real estate investment trust is or a REIT, head on over to my channel here on YouTube. I've created an entire playlist all around real estate investment trusts. So if you're wondering or curious about, investing into REITs versus rental properties, I've shared a video about that. I've shared in-depth videos about, MPW, Omega Healthcare, Good, et cetera, et cetera. There's a lot of great content in here, as well as what a REIT is, how are they taxed, how they perform against the S&P 500, all of those things, so you can check that out there. So when thinking about why dividend investors love Realty Income, I'm going to consolidate it into 5 sections. The first part is going to be around the history of dividend increases. The second, we're going to talk about what the bulls say, the bears say. Third, we're going to talk about the fundamentals. So I'm going to take a look at their revenue, their adjusted funds from operations. And I promise you, if a lot of these terms are going over your head, I'll try to do my best to explain them. Okay. The fourth thing here, we're going to talk about diversification and how Realty Income is almost like investing into an ETF itself. So we'll get to that in a second. And then the fifth thing here, the historical performance, and this actually blew my mind away that I had no idea how well Realty Income was performing compared to the S&P 500. So stay tuned to that. I think that's going to shock a lot of you. But I guess what I can do is let me give you a sneak peek of why I love Realty Income. I love Realty Income is because it's reliable, it's consistent, and it's absolutely the exact opposite of what we're experiencing here in 2022 and how the world you would imagine should function. I think the world is in a really weird place. And the older I get, the more my eyes get open to how crazy the world really is. And thinking about how life is in 2022, you know what? It kind of looks a little like this.
Sire, I have news.
And what sort of news do you have? Not bad news, is it?
Well, to be perfectly frank, it's bad.
Maybe if you tell me the bad news in a good way, it won't sound so bad.
The bad news in a good way. Yes, I can do that. Bad news in a good way, yeah. Wait till you hear this. I bumped into Robert Ronsley. He's back from the Crusades. He just beat the crap out of me in my bed.
Oh my gosh. I am not a political person. I don't talk about politics on my channel, but I think objectively, I think it was just freaking hilarious. Anyways, I'm on Instagram. If you want to see more funny, quirky humor, you can go ahead and follow me there as well. And yeah. All right, so Realty Income, if you've never heard of this company before, it is the monthly dividend company. They pride themselves on that they've been paying a monthly dividend for decades. In fact, 53 years. They've been increasing their dividend consistently and reached the status of dividend aristocrat here recently. They have 25 years of uninterrupted dividend increases. They have a massive real estate portfolio, primarily here in the United States. They have a few properties also in Europe, in Spain, and in the UK. And the cool thing, the interesting fact here is they've actually been around since 1969, but they just went public here in 1994. So you'll see their track record, their public track record since 1994 with the dividend increases and all of that good stuff. So the first part here, why dividend investors love Realty Income, is because of the reliability of the dividend income. And so what you'll notice here is that Realty Income has paid a growing dividend for 25 consecutive years. This makes Realty Income a dividend aristocrat. This is the number one reason, the first reason why dividend investors love this company so much is the reliability and the consistency of the dividend growth. But one thing that you do have to bear in mind, if you see an article saying, hey, Realty Income just increased their dividend by 0.01% or 0.001% or whatever, bear in mind that they increase their dividend multiple times a year. In fact, they've increased their dividend up to 5 times over these last couple of years in a single year. So when you see the highlights or the notification, yet another increase from Realty Income, don't see that as the one and only dividend increase for the year. It's just that's what they've increased year to date. It's very different than other companies like Coca-Cola or Johnson & Johnson, where they increase their dividend usually just once a year. So that's really, really important to remember when looking at the dividend increases of Realty Income. All right, next let's take a look at what the bears say and the bulls say. I like looking at Morningstar's analysts, what they're saying in terms of what the bears are saying, the bulls are saying. So for Morningstar, the bulls are saying that Realty Income provides reliable, albeit slow growing monthly dividend that is built into a steady performing underlying portfolio through various market conditions. So they're saying that, the consistency, the reliability of the dividend is definitely what the bulls are saying, that they're reasonably leveraged. So whenever you're talking about REITs, there's usually, if not always going to be leverage. And with Realty Income, they're very conservative when it comes to how much leverage they take out. And so they're in a very good position where they have a portfolio. When I say portfolio, I'm talking about the thousands of properties that they own. That's what I mean by the portfolio. If they needed to, they could sell off parts of their portfolio that are maybe underperforming or maybe their lease terms expired, and they can take that capital and then reposition it, pay down debt. They're in such an incredible position when it comes to their debt. So that's what the bulls are saying, and that's personally what I think is also really, really great. So what are the bears saying when it comes to Realty Income? What they're saying here is that because the rent escalations are already built into the lease terms, that it's going to cap their growth. Now, that is true on the one end, but I think what we'll get to in a second when we look at their growth rates over time, that is actually not proven to be the case. But the cap on the rent escalations, and if you're not familiar with that, a rent escalation is, so for example, if they have a 10-year lease with a brand like CVS, then there are already built-in rent escalations. And so they're not going to really go above and beyond that in terms of the growth because it's already baked in. So that's definitely what some of the bears are saying. All right, now let's take a look at the fundamentals. I want to look at their income statement, their balance sheet, and their statement of cash flows. This is going to be a little bit nerdy, so we're going to take a look at some numbers. I want to understand the profitability, look at some of the fundamentals, and some of the stuff that you're going to see here. I do have Seeking Alpha Premium, so you're going to be able to see further back. I think if you just have the free version, you don't have the full view. If you do want to sign up to Seeking Alpha, I do have an affiliate link in the description below. You actually will be able to get 58% off. So instead of $240 a year, it'll cost $100, so $99. You will not get a better price. Just wanted to throw that out there. If you want to sign up for Seeking Alpha, there's a link in the description below. And I do want to be upfront. I do benefit from it. So it is an affiliate link. If you do use my link, I do benefit from it, and I greatly appreciate it. Anyways, so a couple of things that I want to take a look at. So first is the revenue. What is the revenue doing? The top of line. Are they growing? Is it fluctuating up and down? And so when you're looking at the revenue of Realty Income, it is very, very consistent. And since the pandemic here, it's seen a massive spike. They've seen a massive spike in revenue. And this has a lot to do with the the spike in real estate costs, right? But the thing that I really want to focus on here is I want to look at their FFO and their AFFO. The difference here is FFO is not taking into consideration the maintenance costs. So I personally, if I'm looking at this, I'm looking at the AFFO, so the adjusted funds from operations. And I will say, I mentioned this earlier that I have other videos on the channel explaining what real estate investment trusts are. With REITs, you don't look at the price to earning. Don't look at the PE. The PE is irrelevant when it comes to REITs. It does not help you at all. What you want to look at is the adjusted funds from operations, in my opinion. So FFO is standard. I like looking at the AFFO. And so for me, when I'm looking at this, just really high level, year over year, are they growing their AFFO? And they absolutely are. Okay, so then what I like to do as well is I want to go ahead and I want to look at their balance sheet. And I want to look at one specific thing. So what I personally look for is I want to see how dilutive they're being with their stock. So dilution is when the company is issuing additional shares. And what that means is if you own shares of the company and they issue more shares, your shares by default are worth less. Okay, so that's what I'm talking about. So their total common shares outstanding, this is what I'm looking at. So what you ideally don't want to see is a massive spike in shares outstanding, right? So you can see here in 2021, they had a massive increase in outstanding shares. And so that kind of puts a question mark out there. Well, why is that, right? That's not ideal in most cases when you're looking at a business. How dilutive are they to shareholders? So then what I like to do is I say, okay, all right, so you're issuing a lot of shares. Are they doing that to, maybe make acquisitions in the market? They're buying other things. Like, what's going on? So then what I like to do is I like to look at, here really quick, I might be going too fast here. I like going under cash flow, the statement of cash flows, and you go down here, and what I want to look at is I want to look at their free cash flow per share. So if they're increasing their share count, what are they doing? What does their free cash flow per share look like? And that's what I'm looking at right here. And you can see there was that massive spike here in 2021, almost double in shares, but they're growing their free cash flow per share. And so that's what I'm looking for when I'm investing into a business, that the company is not diluting me, diluting the shares. Let me give you an example. Let's say you buy a can of Coke, and let's say you've got a big glass and you put the can of Coke in there, but then you start adding a lot of ice. You put the ice in the cup, and then that ice starts to melt away. Your pure can of Coca-Cola is getting diluted by water, and it's not the same. You're getting less and less Coke for every ice cube that you're putting in the glass, and that is share dilution. In real estate, it is fairly common that you're going to have increased shares outstanding. It's just part of the business. But for me as a shareholder, I want to make sure, is this company really taking care of me as a shareholder, and they're not over diluting? And that is absolutely the case, what they're doing, in the sense of they're taking care of the shareholder and they're being responsible with their outstanding shares. The last thing that I want to take a look at here very briefly is their growth. So a couple of things here. The adjusted funds from operation growth, the 5-year history, this is the CAGR. This is a 4.5%, not super high, right? Like 4.5% is not Microsoft. It's not Apple, but it is a respectable CAGR given the industry that they're in. And then the last thing is, let's take a look at their revenue. How is their revenue doing? Over the last 5 years, they've grown their revenue annualized by 19%, and then annualized over 10 years, 20%. This is an incredible business. The fundamentals check out, the growth checks out, just overall really high quality company. And that's why you can see when it comes to the ratings, the Seeking Alpha authors, this is more subjective. They have a hold rating. Wall Street has a buy rating. This is a little bit more objective with a little bit of subjectiveness kind of thrown in there. And then the quant rating is proprietary to Seeking Alpha. This is just purely objective based off of fundamentals. Okay. And so it's overall, when looking at the fundamentals, the reason why dividend investors love this company is solid. It is absolutely solid. So now let's talk about Realty Income, the business itself. Let's take a look at the portfolio, the different type of properties that they own, the diversification. You mentioned you heard me say earlier that Realty Income is like an ETF. It is that diversified. And I'm going to explain what I mean by that here in a moment. So Realty Income is primarily in the UK, in Spain, and in the United States. And so if you really peel back the layers here and you look at the diversification, this is what dividend investors like myself absolutely love about this business. This is what everybody harps on, why dividend investors love this company is because of how diverse it is. There's a couple of things here that you're looking at on your screen. Let's focus here on the left side. The left side is their top 20 tenants or clients, like the brands. So they're working with Walgreens, Dollar General, 7-Eleven, Dollar Tree, Family Dollar, FedEx, LA Fitness, and the list goes on and on, Walmart, Sam's Club, etc. So a lot of these businesses, even Home Depot, I mean, absolutely incredible. A lot of these businesses are, when you think back during the pandemic, how many of these companies were shut down during the pandemic? Only a very, very small handful of them. At the peak of the pandemic, LA Fitness was shut down. They were shut down right down the street from me. The 7-Eleven was still open. Dollar General was open. Walgreens was open. Walmart was open. Home Depot was open. AMC was shut down, right? So you think about it, even in the worst of times, the worst imaginable time ever, these companies, the overwhelming majority, were still open for business. Now looking at the industry diversification, this is something to really highlight up over here on the top right, the percentage of the industries that they're in within retail. So you think about retail. Retail is not just shopping centers. There's a handful of micro verticals within retail. Okay. And so when you think about the micro verticals, you got grocery stores, you got convenience stores, dollar stores, restaurants, drugstores, home improvement stores, health and fitness, general merchandise, and automotive services. And so this is what I love. It's not just, like you compare it to maybe like a Simon Properties, for example, who owns maybe luxury or, shopping malls, right? Very straightforward, very, very laser focused in their demographic, their target demographic. It's the complete opposite with Realty Income in terms of the diversification of their portfolio. And then here in the bottom right, where is their portfolio in terms of geolocation, right? Because if you know anything about real estate, it's like location, 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 right? So their largest centralized portfolio is in Texas, where I live. The second largest is in the UK, and then California, Illinois, Florida, Ohio, and Georgia. And here, 84% is retail, 14% is industrial, and just under 2% is in other. So the last thing that I'll say here is one of the things that I like about ETFs is the broad diversification. When you buy Realty Income, it's almost like buying an ETF because of how diversified their business is. And that's what I, as a dividend investor, personally love about the business. All right, now let's take a look at how Realty Income has compared historically to the S&P 500. Now we're going to look at this from a couple different lenses. First, we're going to look at it from the price return based off of time frame, and then what we're going to do is we're going to look at the total return based off of time frame. So if you watched my last video, you probably have heard me say the word total returns about 1,000 times. This is what I want to focus on is first the price return. So the price is the appreciation. It's not with the dividend reinvested. The total return is with the dividend reinvested. It's the capital appreciation plus the dividend. So year to date, Realty Income is well above or performing much better than the S&P 500. When you extend this out to 3 years, the S&P 500 from a price perspective is outperforming Realty Income. If you look at this for 10 years, now here's the thing. Now let's take a look at this with the dividend reinvested, and let's take a look at this with the total return. The total return tells an entirely different story, okay, over the long term. Now, year to date, not too much has changed. Let's take a look at 3 years. 3 years, okay, we're decreasing that gap, right? Now let's take a look at 10 years. At 10 years, we're almost at parity. We're almost at the same total return. Now, I want you to take a second. I want you to take a breather. Just breathe, sit down, and watch this, okay? If we go back, we know that they went public in 1994, I believe, at the end of 1994. Let's take January 1st of 1995, and I want you to look at the total return. Look at that. That orange is not the S&P 500. It's Realty Income. With the dividend, Realty Income has absolutely destroyed the S&P 500. Investors always talk about the total return, which I did in my last video. Dividends absolutely matter. Now let's take a look at this without the dividend. Without the dividend, the S&P 500 is beating. But because the dividend is part of the total return, it tells an entirely different story. This is absolutely incredible. Now, let's take a look at another scenario here. So you might be thinking, well, Jake, S&P 500, it's kind of apples to apples, maybe not really. Well, let's take a look at, REITs. Let's take a look at Realty Income. Over the last 10 years, let's first look at the price return here. To add this feature, you will need premium, so you're not going to be able to do this with the free version, but you can check it out. You can see it here on my screen. If you're comparing the three, VNQ has actually performed the worst out of the three over the last 10 years with just the price, but take a load of this. With the dividend reinvested, even VNQ, which is skewed more towards growth, right? Like data centers, cell towers. But even then, Realty Income is outperforming VNQ. So at the beginning of the video, I told you that I would share why I personally love this company. So in addition to everything that I just shared in this video, the reason why I love this company is because of the consistency and the reliability of the dividend. The way that the company is run and operated, it's ideal for a dividend investor like myself who's looking to live off the dividend income in retirement. And so that I really feel that I can rely on the income every single month in retirement. But the thing that I want to highlight here is it just outlines it perfectly of why I love this company so much. The first section here at the very top, they just recently purchased a resort and casino for just under $2 billion at just at a 6% cap rate. But here's the key thing. This transaction, it was under a 30-year triple net lease with favorable annual escalators. These annual escalators are rent escalators. So whether it be inflation adjusted or not, for the next 30 years, Realty Income will own this building, but it's under a triple net lease, meaning they don't have to pay the taxes, they don't have to pay the maintenance fees. Everything around this building, it is fully operated by the casino, but Realty Income owns the building. And this is a very common practice with Realty Income and the real estate that they own. Once again, it comes down to reliability. And that, everybody, is one of the many reasons why I love Realty Income. Thank you so much for watching, everybody. I hope that this video was helpful. I know we dived into a lot of different things here. We talked about a lot of different terms. If you're not familiar with everything that I said in this video, or if some of the things went over your head, I would encourage you to watch some of my other videos on what a real estate investment trust is, because I think if you're a new investor and maybe you're a more risk-averse investor, REITs are a great way to shield you from the volatility in the market while still getting consistent, reliable cash flow. Thanks for watching, and I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.